welcome to the Ledger Report. Today, we're going to dive into the drama around the IRS reporting requirements news that has come out to begin the year of 2025. Now, the point of this video in this channel in general is to address a lot of the madness that is circulating around the internet regarding digital assets and blockchain, especially on X. Right now, I'm seeing a lot of stuff that is way out there, and I ran into something yet again today that I'm not going to lie, it made me laugh, but it also made me feel like there actually may be a need to add a little bit more conversation about digital assets, distributed ledger technology, and if I have to say it, cryptocurrency, and the realities of how this technology works and other practicalities around what's happening in the ecosystem. So this channel is meant to provide a more practical approach to the news in this space, and just keeping things light, but also a little bit realistic, because there's a lot of things that we're seeing out there. There's a lot of rumors, a lot of stuff that gets propagated by bots and people that are copying other people's tweets and pretty much just instantly spreading information that's not necessarily being vetted or even, quite honestly, if we're being real here, thought through at all. And I just want to provide a space for people to kind of have a source that they feel like is keeping them grounded, but also still enthusiastic at the same time. So like I said, want to keep things grounded in the facts during these really exciting times, because trust me, I am just as excited as everyone else. So look, we're seeing a lot of things on X and on the internet in general that are just, one, not true, two, hyperbolic in nature, whether this is things that are on the chart or off the chart, and also things that are just actually intentionally crafted to generate interaction in the form of what is called engagement farming. So the Ledger Report is really about bringing the facts back to the forefront, whether these are things that we can verify on chain or just things that we can kind of dispel based upon what is in legislation or other hard facts that we can provide to this ecosystem. So look, this is for enthusiasts and skeptics. We just want to get a more level look at what's happening, point out some of the clear engagement farming. I see a lot of people reporting on that. And it's getting a lot of traction. And let's just point out some of the clear misunderstandings and have some fun. So if you do think that this will be helpful, before we even get started, please do like this video and subscribe as we head into this very new and exciting year. There's going to be a lot of news. There's going to be a lot of fun stuff going on, and I'm definitely looking to bring this if you guys are interested in it. So just let me know. And by the way, if I misspeak or have any inaccuracies throughout this video or any others, I'm human too. So just let me know in the comments, and just know that I want to learn even more than I want to sit here and share. So if you guys have information, please bring it to my attention. I'm happy to report on it, correct myself, and also just learn with you guys. So look, today we're diving into the IRS's decision to delay a regulation on crypto tax reporting. Okay, a lot of funny stuff circulating about this, so I had to come on. We're gonna break down like what the actual rules are here, what's the drama about, why is this controversial, and when is this supposed to actually come into effect. And as we wrap things up today, we will get a little bit of speculation for my enthusiasts, so just be sure to stick around to the end. We're gonna ground that all in facts. So before we get too deep, I just want to make it clear, I'm not a lawyer, I'm not a tax advisor, and none of this is legal or tax advice. And once again, if I make an error, just let me know. So look, let's start with how this all got started for me today, because this was hilarious. So Watcher Guru, one of the largest accounts in this whole FinTwit space, I wouldn't even just put them on the crypto side, but they said, hey, just in IRS delays, crypto tax reporting requirements until 2026. Now, when I read this, to me, this does not say that no one in crypto needs to pay taxes. That's not what I'm reading. But now, as the author wrote this, they definitely intentionally left what they said a little bit ambiguous. Okay. So what happened is people took it and of course they ran with it. And trust me, the people that are posting this know that. They know that people are going to run with this. They know that what they said was not clear. Okay. So this was my favorite. This is literally the one that inspired this video. Wendy, you inspired me. She goes, no more crypto taxes. Okay. As a response to that tweet from Watcher Guru. And let's be clear, she knows what she's doing. She has 400,000 followers, right? So she knows what she's doing. This isn't an accident, right? So this is not what that tweet says. And she knows that this is not what is going on, right? But this is the type of stuff that is being circulated on X day in and out. And unfortunately, I think a lot of people get caught up in not understanding that this is satire, okay? Okay, so moving on. Wall Street bets, continuing to pile on and add on to what's happening here. The IRS just hit snooze on crypto tax. So now people have even more time to flex their investment muscles. Like, okay, that's not what's happening. So we're going to dive into what is happening. But I just want to highlight this and the toxic nature of this space and really how, we talk a lot about the mainstream media and then we criticize the mainstream media because there's a lot of fake news and this and that. But what we're starting to realize is in this digital age that things are simply changing, right? There's a new form of that fake media, and what we're going to call it is engagement farming. Okay. So just keep your head on the swivel. If you guys see stuff like this, or you want to get someone to check it or whatever, just let me know in the comments. We have a lot of smart people out here as well. So trust me, I'm not going to be the smartest person in the conversation, but I wanted to bring it in an entertaining, fun video format. Shehan, the crypto CPA, he says the IRS is not delaying your obligation to report taxable crypto transactions, right? So he's like, let's get this clear. That's not what's going on, guys. And then Bark Meta says the IRS has delayed crypto tax reporting until 2026. What it means, you still have to pay your taxes, Anon. So, all right, let's get into this, guys. First, let's talk about the implications. We'll do a TLDR so that you can get on with your day. Look, none of this has anything to do with relieving an American digital asset holder's obligations to the IRS from their crypto transactions. You're not off the hook for taxes. If you owe to the IRS, you still owe them. Now, what this temporary relief issued by the IRS does cover is two major points that have developed over time. We'll dive into the details in just a second. First thing is the way in which taxes on digital asset transactions are reported, and even more specifically, how they are reported by brokers, okay, who are responsible for facilitating these digital asset transactions. So we're talking about exchanges, we're talking about Coinbase, we're talking about Kraken, we're talking about regulated exchanges in the United States. So the second thing that was important about all of this is that the default accounting method that these brokers are supposed to use for reporting gains on these digital asset transactions is the first in, first out method. Okay. So what the IRS was saying, and the Treasury as well, they're together in this, is that if you are not going to specify the way in which these transactions were made, or you'd like to report them, then you're going to be defaulted by these exchanges to use the first in, first out method, which we'll dive into what that means in just a little bit. But just know that it's not advantageous for you as an investor. And in reality, that whole concept, that idea is probably not going to fly. So anyways, here we go. Especially trying to leave it to default. But what does this mean? Look, when you report taxes on capital gains transactions, there are several methods that you can use to report the gains in order to alter your cost basis. And we'll talk about this in just a second. This image here on the screen, shout out to Nicholas Boucher, I believe that's his name. This is just what I've learned throughout this process, is that this isn't just something that happens in accounting for money, but this is also something that happens when accounting for physical items as well, which is really important, and it makes sense. Anyways, the first time that you buy something, let's just say you buy something for $100, and this is, in the stock market, let's say, and you sell it for $200, right? The difference between that 200 and that 100 is a $100 gain that you have on that asset. Now, assuming that you're going to pay long-term capital taxes, capital gains taxes of 20%, let's just imagine that's the number, you're going to owe $20 on that $100 gain, right? Now, let's imagine that later on you bought another, let's say, share in Tesla at $150. Now, you only sold one, once again, at $200. Now, for that transaction, if you were to sell that later transaction, you would only have a $50 gain on that specific purchase. So what you could do is take that $50 gain and pay 20% on that, right? Which is going to be $10 instead of owing $20. So if you were able to not report the first transaction that you made on that stock at $100, but you could instead use that second transaction, right? You would have a smaller gain that you'd have to report for that specific amount in the transaction. So we're not going to go deep into this today. This is not the point of this. We're going to move on. If you want to learn more about that, you can absolutely find videos and plenty of information about the first in, first out. There's also the highest purchased price is sold first, highest in, first out. You have the specific transaction ID, and you have the last purchase first out as well. It's another method that you can use for crypto accounting purposes, or excuse me, for tax, capital gains tax purposes in general. So anyways, the most spicy bit about all of this, okay, has been the definition of a broker and their newfound obligations, as the regulation includes both centralized and decentralized exchanges through language that we're going to look at in just a second. And what seems to have happened here is that the IRS decided on December 27th that they would make their ideas that they released in 2023, they would make them official, and they would also tell us when they're going to come into effect, which was going to be about 60 days from December 27th, 2024. What happened was they got a ton of resistance about this, and they gave people 60 days to be in compliance with this regulation after only floating it as a proposal, as a proposition. And it just appears that no one's really ready for that. So at the end of the day, what's the point of a rule if no one's going to comply with it anyway? Moving on, the IRS just a few days later, as we saw a second ago, just said, hey, you know what? We're going to push this down a year. Clearly, no one's ready for this. And unfortunately, it looks like the IRS and the Treasury are not going to be able to participate in the 2025 bull run. Not in the same way, at least. So look, let's break all this down real quick. So August 29, 2023, the Treasury and the IRS published these proposed regulations regarding digital asset transactions and brokerage definitions regarding tax compliance. So what they did was they defined a broker, all right, in a way that encompasses participants in DeFi. And specifically, I'm going to point out this language. This is coming straight from the documents here. A group of persons providing services that together carry out a customer's digital asset transaction may be treated as a broker, whether or not the group operates through a legal entity. So they're trying to cover DeFi, right? Pure and simple. They're trying to make sure that DeFi brokers are also being held responsible for these reporting requirements. Now, if you participate in this space, you probably know that that doesn't really make any sense either, now, does it? Does it really? It really doesn't, because who exactly is going to be responsible for that? Are you saying the person that launches the smart contract on the blockchain? Are you saying the people that facilitate the validation of the transactions that run nodes that validate on these blockchains are the ones responsible? Who exactly is going to be responsible? It quite honestly, it shows a lack of understanding of the technology. It shows a lack of wanting this technology to thrive. And it's unfortunate, because this is the reality that we've been dealing with for many, many years now. We're going to talk about in a little bit why we may potentially see a change. But for right now, I mean, this is ridiculous. What are you supposed to do with that information? I mean, a group of persons, right? So, anyone can launch a smart contract. In fact, a monkey could do it. A monkey could sit down at a computer and do it. Are you going to say that the person, the IP address from which the smart contract was launched, like, you see where you get into the internet in general, it also caused a lot of problems with regulations. But this one specifically is also a little bit tough, and we don't have a lot of ways to define these persons that the legal definition would like to typically define. So let's move on. As you guys know, there's a difference between a centralized exchange and a decentralized exchange. Coinbase, Kraken, these centralized exchanges that essentially act like typical traditional exchanges or banks that facilitate transactions. These are persons under the United States law. These are entities, physical companies, and people that you can go after. In DeFi, you might have someone who launches a smart contract, but then no longer is a part of anything that happens from that point forward. It's now up to a group of people that are transacting on this blockchain, a group of people that are validating the transactions that are happening. And that process is no longer being controlled in any way by the person that launched that contract. And that person could be someone who's working independently. It could be a group of people who are in no way know each other even, and they could also be in completely different jurisdictions. So you're asking people to comply with laws that may not apply to them in their jurisdiction or wherever they are. And we'll talk about how someone also just found that this might have potentially been unconstitutional and so on and so forth. Anyways, okay. On June 8th was when the IRS, June 8th, 2024, they released a final ruling about the FIFO method, right? So what we were talking about a second ago. So there's two different things that have happened basically. In June 8th, or in August 2023, they defined this broker thing. In June 8th, 2024, they said, hey, we're going to make this first in, first out thing official starting the 1st of January, 2025. Now, they're forcing, once again, the centralized exchanges to report these transactions as the first in, first out method by default, right? If they don't have a way to ask people, hey, would you like us to report it this way or that way? If they don't have a way to do that, then they just have to default to the first in, first out method, which is absolutely horrific for asset holders. Once again, we're not going to dive deep into that. So anyways, what happened is pretty much on the 1st of January, the 31st of 2024, the IRS recognized that brokers don't have the technology to do this right now, immediately. So that 60-day timeline was too short. And so they couldn't expect exchanges to start reporting all of these transactions in that short of amount of time. And so that's what all of this controversy has been about. So anyways, from the 1st of January to the end of this year, 2025, taxpayers are actually going to be able to use their own methods and maintain their own records about what's happening. Now, starting next year, 2026, they will be required to follow these rules. These brokers will be. And that's assuming that nothing changes, which we're going to talk about why that's highly unlikely. So yeah, once that rule takes effect in 2027 is when it really takes effect, but these brokers will have had all of the transactions for 2026. They're going to be collecting all this data. And according to the IRS, there are about 650 and 875 estimated DeFi brokers that will be affected by these final regulations. Now, this is a weird statistic because we only have a handful of regulated exchanges in the United States. And so this clearly suggests that they're going after those DeFi protocols as well. The next thing that they stated is that there's going to be about 2.5 million taxpayers affected by these changes, which is also a really weird number because you have anywhere from 16 to 93 million people that are estimated to hold cryptocurrencies in the United States. So that may suggest that the IRS themselves might not have the tech to keep up with what it is that they are suggesting themselves. So we won't dive too deep into that. We're just going to keep it pushing. So the Blockchain Association, all right, and the Texas Blockchain Council saw what was going on. And a couple of days after this legislation was put out, they actually went ahead and filed a lawsuit against the IRS, citing a violation of the Administrative Procedure Act, basically saying that this was not constitutional, and they believed that they needed to push back on this. So with all that said, that's pretty much what I've got for today. Now it's time for my speculators. So listen, on this one, the source, I made it up. I'm just kidding. We're going to talk about some facts, but I do want to just kind of set the stage for this segment where we're just kind of projecting a little bit of what may happen here in reality. So listen, around the world, if you've been paying attention, maybe you haven't seen this, but look it up. There's been a lot of rumblings about a potential strategic cryptocurrency reserve. And this is from many different countries, okay? The United States already holds 1% of the total Bitcoin supply. And I found a really cool article on CoinGecko, okay, that shows that governments on record, right, what we already know about, hold more than 2% of all of the Bitcoin supply. The highest holders are going to be the United States of America, China, and the United Kingdom. Okay, they're leading the way. And we've also seen that many others, okay, have actually been talking about this, the same exact concept of a Bitcoin reserve. Obviously, El Salvador as well. They kind of told the IMF, hey, we're going to stop doing this, and apparently kept buying Bitcoin. Don't know exactly what's going on there, but that's their drama to figure out. But look, we've got Brazil, Poland, Russia, Switzerland, and Germany have all had members of their government actually bring this idea forward in a more formal kind of way. Some of them have not been formal. Some of them have been more just discussions here and there. And we're not even going to talk about central bank digital currencies. Okay, we're going to leave that for another discussion. We'll get into that later. But just know that there are hundreds. Okay, there's only 192 countries, something like that. There are a ton of countries that are talking about this. All right, this is my speculative moment, so give me that. There are a ton of countries that are talking about this, and when it comes to CBDCs, we have a lot on record as well, actually piloting and running tests using distributed ledger technology on record for 4+ years. By the way, this has been going on. Anyways, listen, let's talk about it this way. In the United States, the incoming administration has made it very clear of what its stance is on this technology. We have a crypto czar, David Sachs, from the All In podcast, huge fan. We have a well-informed SEC chair that's been nominated, Paul Atkins, who still needs to be confirmed. Let's be clear. We have a well-informed Secretary Treasury in Scott Bessent, who still needs to be confirmed, to be clear. And, looking at this chart here, these are just some of the, people that are in this administration that he has nominated so far. These are all the billionaires, basically. They're all very wealthy people. There's a lot of pro-capitalism, a lot of pro-economic growth that's happening right now, and it's very clear. But for the not so obvious, right, we have a national intelligence director that's been nominated, Tulsi Gabbard. She needs to be confirmed. She's already disclosed her holdings of cryptocurrency. She is an owner of cryptocurrency. We have the National Security Advisor, Michael Waltz, who has disclosed his holdings of cryptocurrency. And you probably didn't know this. VP JD Vance, who does not need to be confirmed, has publicly disclosed his holdings of cryptocurrency as a senator. And let's not forget about Doge and the co-chair himself, Elon Musk. We already know what he's done in the past. I won't talk any positively or negatively on that, but we know where he stands. And oh, by the way, there's this random guy. His name is Bo Hines from North Carolina. I don't know if anyone knows who this guy is, but he also is being appointed as the executive director of the Presidential Council of the Presidential Council of Advisors for Digital Assets, which is chaired by David Sachs. He's going to be the executive director. Once again, I have no idea who this guy is. If you guys know who this guy is, please let me know. It looks like he ran for Congress in North Carolina and didn't win, and he played football at North Carolina State. Don't know what this guy knows about crypto, and it definitely makes me question what exactly is going on around here. But anyways, let's make this clear. All right, the incoming president in the United States plans to make America the crypto capital of the planet. Let me run that back because this is in quotes. Make America the crypto capital of the planet, end quote. Now, that's just the facts, right? These are just things that are true. Let's not forget that when it comes to these politicians and politics, they are professional flip-floppers. Okay, they are professionals. So let's not let this excitement blind us from seeing and calling out any of the potential ulterior motives that are at play. Okay, because we know there's a lot of weird stuff going on, and in reality, a lot of this cryptocurrency and blockchain technology, if not treated properly, can absolutely be used against us. So for now, everyone, this has been the Ledger Report. Be sure to like this video if you watch to the end, especially. Come on now, like and subscribe for the next one. And tell me exactly why I'm an idiot in the comments down below. Until next time, stay vigilant.